We reviewed 5 TradingView indicators across different use cases, ranking them from lowest to highest, with pros and cons for each. Let's dive in. Trauma. Trend regularity, adaptive moving average. Developed by LuxAlgo, this indicator applies adaptive logic to moving averages by adjusting its responsiveness based on trend regularity. The method works by evaluating whether the highest or lowest price values have changed over the defined length. If so, it interprets the market as trending and adjusts the adaptive coefficient accordingly. This coefficient, squared for further smoothing control, is then used to adaptively pull the average closer or let it lag further, depending on current price action stability. Trauma's primary use is trend following with enhanced noise filtering. In markets where sharp breakouts are followed by consolidation, this moving average adapts quickly during directional movement, but slows down during chop, reducing false signals. It doesn't aim to pinpoint tops or bottoms, but rather to hold during sustained trends and avoid frequent whipsaws. For strategy use, it suits trailing stop frameworks or as a dynamic trend filter. For example, a crossover of price above trauma might be treated as a signal only if the trauma line has an upward slope, avoiding early entries in ranging conditions. Alternatively, combining trauma with faster EMAs or volatility filters can help refine entries during acceleration phases. Customization is minimal, with only the period and input source configurable, making it simple to apply but less flexible for those wanting extensive tuning. Pros: trend responsiveness adaptation, noise reduction during range-bound phases, simplicity of use. Cons: limited configurability, lack of multi-timeframe features, no visual cues for trend strength. Ranking: 7.5 out of 10. Trauma offers a mathematically elegant and practical solution to smoothing price action without overfitting. It balances simplicity with logic, especially for traders seeking trend clarity with minimal parameter tuning. While not a complete system by itself, it adds stability to directional strategies without crowding charts. Triangular Hull Moving Average plus Volatility. Created by Big Beluga, this indicator merges a modified version of the Hull Moving Average, HMA, with volatility overlays to enhance trend detection and signal responsiveness. The THMA modifies the original HMA logic by applying a triple-layer weighted calculation, aiming to smooth price while minimizing lag even further. The indicator introduces dynamic candle coloring based on the slope of the THMA, providing a visual distinction between uptrends and downtrends. This is complemented by volatility bands calculated via a smoothed HMA of the high-low range, scaled using a percentile-based normalization. The result is a banded channel around the THMA line that visually communicates market expansion and contraction. Directional signals are generated using crossover and cross-under logic between the current and delayed THMA values. These signals are reinforced visually with colored triangle markers that adapt to average true range levels, offering clear potential entry or exit cues. The volatility component not only adapts the visual strength of the bands, but also displays a real-time percentage-based volatility reading. This dual display, trend direction, and relative volatility allows users to quickly assess both market condition and directional bias. Potential strategy options include trend continuation plays during strong THMA slopes confirmed by high volatility, or reversion setups as price exits the volatility channel. The indicator may also function as a visual trade filter alongside faster entries or macro-level analysis. Pros: trend clarity through smooth structure, volatility-informed visual context, signal simplicity via crossover logic. Cons: limited customization of signal logic, fixed volatility, scaling method, dependence on average true range for distance signals. Ranking: 7.8 out of 10. The indicator presents a thoughtful blend of trend smoothing and volatility context. While the visualization is clean and the logic intuitive, deeper customization or more nuanced logic might improve adaptability across strategies. Still, it's a well-constructed tool for directional confirmation and visual reinforcement. Range breakout. Developed by Big Beluga, this Pine script indicator offers a dynamic approach to identifying breakout opportunities through adaptive range channels. It constructs a central channel using a 200-period ATR smoothed over 100 bars, multiplied by a user-defined factor. The upper and lower channel boundaries expand with volatility and reset upon breakout events, or after 100 bars without significant movement. These channels are visualized with layered lines and optional gradient fills, providing visual clarity without clutter. Upon breakouts above or below the channel, the indicator marks the event with a distinct signal, suggesting potential trend shifts. Additional visual cues highlight midline crossovers, and optional X markers can flag possible fakeouts for those wary of false signals. Traders can choose to filter these signals based on the current channel trend, adding an extra layer of contextual relevance. This tool is well suited for traders seeking a structured breakout system that adapts to changing volatility. Scalpers and intraday traders may use it for timing entries, following volatility compression, while swing traders might rely on confirmed breakouts as entry or exit points. The logic emphasizes clean structure over reactive noise, making it useful in choppy markets or when confirmation is a priority. Pros: volatility adaptation, breakout visualization, signal filtering flexibility. Cons: repainting risk at breakout reset, signal dependency on bar confirmation, limited backtest capability. Ranking: 8 out of 10. While not groundbreaking in concept, the implementation stands out with clear visuals and practical filtering mechanics. Its originality lies in subtle refinement rather than novelty, making it a reliable utility in a trader's toolkit. Best used with complementary confirmation tools for optimal results. Support resistance channels. Created by Lonesome the Blue, this indicator identifies and displays dynamic support and resistance channels based on pivot clustering. It scans past price data for pivot highs and lows, grouping nearby levels into bands when their range falls within a user-defined percentage of recent price extremes. Each channel is scored by how many pivot points it contains and how often the price has respected it during a look-back period, giving weight to historically reactive areas. Visually, the indicator draws boxes on the chart representing these zones, with color coding that adapts based on whether price is inside the zone, above resistance, or below support. As price moves, broken zones can be optionally marked, helping traders track recent shifts in structure. Customization includes pivot sensitivity, channel width, look-back range, and optional moving averages, making it adaptable for different timeframes and trading styles. Use cases include identifying congestion areas for range-bound strategies, setting take-profit or stop-loss zones in trend trades, and monitoring structural breakouts. Since the channels are based on recurring pivots, they often align with naturally reactive zones in the market, providing a grounded framework for both discretionary and semi-automated systems. Strategies could involve trading rejections within channels or confirming breakouts with the built-in alert logic for broken support or resistance. Pros: contextual channel formation, adaptive historical relevance, visual clarity through color zones. Cons: subjectivity in pivot definition, channel overlap, risk-limited breakout forecasting. Ranking: 8.2 out of 10. While not revolutionary in logic, the indicator effectively captures price structure using a thoughtful and flexible method. Its strength lies in combining pivot density with user-driven thresholds, producing clean, relevant zones for strategic decision-making. Originality is modest, but execution and visual design offer practical value for both short-term and swing traders. Oscillator Workbench Chart. Created by LucyF, this comprehensive Pine script indicator transforms multiple oscillators into a unified weighted analysis system for market direction assessment. The workbench combines up to 3 oscillators, 2 built-in selections plus 1 external input, into an aggregate weight that influences price-based moving averages, creating oscillator and divergence channels for market state identification. The indicator calculates normalized weights from selected oscillators by measuring their distance from center lines relative to historical extremes. These weights modify a reference moving average to create a weighted version, with the gap between them forming the oscillator channel. The system identifies 4 market states: bull, bear, strong bull, and strong bear conditions, based on price position relative to reference levels and directional momentum of both lines. The divergence detection engine monitors opposing movements between reference and weighted lines, establishing dynamic channels that capture periods of market indecision or momentum shifts. When divergences occur, the indicator creates temporary zones that track subsequent price behavior until breached, providing early signals for potential trend changes. Relative volume weighting adds another dimension by amplifying oscillator influence during high-volume periods, while customizable capping prevents extreme oscillator readings from distorting the visual scale. Strategy applications include trend continuation signals when both channels align in strong states, reversal identification through divergence channel formations, and momentum confirmation through oscillator channel transitions. The workbench supports various trading approaches, from scalping with short period settings to swing trading with longer lookbacks. Pros: multi-oscillator synthesis, volume integration capability, dynamic channel adaptation. Cons: sideways market weakness, signal frequency variation, configuration dependency. Ranking: 8.5 out of 10. This indicator excels at consolidating multiple technical perspectives into coherent visual feedback through its innovative price chart overlay approach. The dual-channel methodology provides robust confirmation systems, though the divergence detection may produce premature signals during ranging markets. In our previous video, we reviewed another 5 advanced TradingView indicators with strategies coming your way soon, so you'll definitely want to take note of them.